In today's videos, should you include crypto in your retirement plan? Setting up your retirement goals. Setting up a retirement target depends on various factors and your target may differ significantly from others. But generally, you can use this simple calculation to come up with a rough estimate. First, estimate your yearly living expenses during retirement. You generally need about 70% to 80% of your pre-retirement income to maintain your lifestyle. If you currently earn $100,000 annually, plan for $70,000 to $80,000 per year in retirement. Next, estimate your potential post-retirement income including pensions, rental income, interests, and dividends. We'll call this annual post-retirement income. Lastly, determine the number of years you expect to live in retirement. It's common to use the average lifespan in your country, but it's recommended to add a few more years to this number. If you plan to retire at the age of 65 and your country's lifespan is 80 years, then you'd need to live in retirement for 15 years. To calculate your total retirement target, use this formula. Annual retirement expenses annual post-retirement income, * years in retirement. For example, if you need $80,000 per year, expect $30,000 annually from your post-retirement income, and plan for 30 years of retirement, you'd need $1.5 million in retirement savings. $80,000, $30,000, x 30 equals $1,500,000. Of course, these are rough estimates. You can always try to come up with more customized retirement targets to fit your specific needs and lifestyle goals. How did crypto perform in the past? Crypto has shown impressive historical performance, especially the leading coins, Bitcoin, BTC, and Ethereum, ETH. Bitcoin, launched in 2009, is the first and most valuable cryptocurrency. If you invested $100 in Bitcoin in July 2010, when the price was around 6 cents, it would be worth around $50 million as of mid-2023. That's a total return of 49,999,900% over a 13-year span. Ethereum, launched in 2015, introduced the world to smart contracts and decentralized applications. If you had invested $100 in Ethereum during its initial coin offering, ICO, in 2014 at 31 cents per coin, your portfolio would be worth around $580,644 in total. As of mid-2023 when Ether is worth around $1,800. But these extraordinary long-term performance is coupled with extreme volatility. If we look at Bitcoin's yearly returns, you'd see that its prices increased 5,500% in 1 year and dropped more than 80% in another. But there are a couple of key takeaways looking at the two leading cryptocurrencies' past performances. One is that the longer you stay invested, the higher the returns you'd have gotten. Using 2021 as a benchmark, if you had stayed invested in Bitcoin for 1 year, your return would be 59%, versus 1,133% for 3 years, 4,686% for 5 years, and 876,509% for 10 years. Understanding monetary policy and inflation. When we examined the past performance of crypto, gold, stocks, and real estate in the previous section, we didn't factor in inflation. Inflation is a sustained increase in the price level of goods in an economy over a period. Inflation reduces the purchasing power of money, meaning your money loses its value over time. That's why inflation is a key factor to consider when planning for retirement. Several factors contribute to inflation. One of the most significant factors is the government's power to print money at its discretion. This increases the supply of money. If the amount of products remains unchanged but the amount of money increases, the price of the products would naturally increase. One thing to keep in mind is that the world's major central banks have printed unprecedented amounts of money in the tens of trillions of dollars since the global financial crisis in 2008. Core inflation in the U.S. averaged 4.48% per year between 2020 and 2023 for an inflation total of 14.04%. That means your 15% average annual return in the S&P 500 index would only be 10% after factoring in inflation. How much of your retirement funds should you allocate to crypto? You should remain careful in your approach when adding crypto to your retirement pot, considering all the risk factors and your own risk tolerance. Cryptocurrencies are highly volatile and can be risky, so they should only form a small portion of a diversified portfolio. A recommended starting point could be allocating around 5% to 10% of your retirement portfolio to crypto. However, the right allocation depends on your risk tolerance, investment horizon, financial situation, and investment goals. You should also adhere to a critical investment principle, diversification. You should invest across various asset classes including stocks, bonds, cash, real estate, and gold. It's recommended that you diversify within your crypto investments too. Don't put all your crypto holdings into one coin only. How to build your crypto retirement portfolio. Consistency is key when building a retirement portfolio, especially when you're investing over decades. A common strategy is dollar cost averaging, commonly referred to as DCA. With DCA, you invest a fixed amount regularly, regardless of the price. For example, you can invest $500 every month in Bitcoin for the next 10 years. This could potentially mitigate the effects of short-term volatility and reduces the risk of making large investments at inopportune times. When deploying a DCA strategy, always refrain from panic buying or panic selling during market upswings and downswings. You must follow your long-term plan meticulously. Patience and discipline are vital in this strategy. Benefits of incorporating crypto in your retirement plans. There are benefits and disadvantages to incorporating crypto in your retirement plans. The benefits include 1. Potential for high returns. Cryptocurrencies have the potential for high returns compared to traditional assets according to their past performance. Remember that past performances are no guarantee of future returns. 2. Diversification. Cryptocurrencies make up a new asset class that doesn't move completely in tandem with traditional markets. There is a limited amount of data as crypto is still new and the relationship between crypto and traditional assets continues to be debatable. 3. Inflation hedge. Cryptocurrencies like Bitcoin can act as a hedge against inflation. Please note, however, that the history of Bitcoin as an asset is short since its birth in 2009. Some point out that the global monetary conditions have been loose for most of the existence of crypto. Therefore, the evidence of this claim is not conclusive. Risks of incorporating crypto in your retirement plans. The drawbacks of investing in crypto in your retirement plans include the following. 1. Volatility. Cryptocurrencies can experience severe price fluctuations. If you cannot tolerate such volatility, crypto may not be for you. 2. Regulatory risk. Cryptocurrencies face uncertain regulatory landscapes worldwide. You must ensure you understand the regulation and laws in your jurisdiction and internationally to make sure you are compliant with all necessary regulations. 3. Lack of consumer protections. Unlike traditional retirement accounts, if your crypto is stolen, it's often gone for good. Regulation of the crypto market are still being formulated in some countries, and investors in crypto may not have the same level of protection as in traditional markets. 4. Taxes may be complex. Cryptocurrencies are taxed differently in each country, but it's generally quite complex to figure out how you should consider tax factors when planning for retirement. Sometimes, such regulations may not have been put in place, presenting significant uncertainties. Thanks for watching.